Morning, this is Wayne Bilal with another smart profit maximizing moment. It's Thursday. Good Lord, I have to think about it. It's a problem with tax season. All the days run together. Um, t- Again, my name is Wayne Bilal, and I'm the founder of a local CPA firm. Founded it in 1991, so I've been doing this a long, long time, helping a lot of people. And the creator of the smart profit maximizing system, which is designed to help my business owners make more money. Simple as that. The T of the SMART is taxes, paying as little as possible. And we got some good news. Contrary to what you're hearing in the media, all right? About the IRS's own statistics say 4 million tax returns are going to pay more taxes under the new law. Sounds like a lot. It is. Let's be honest. If you're one of those 4 million, you're not happy, all right? What they miss is over 150 million returns are filed every year. So that means, do the math, around 2.5, 2 to 3%, depending on what numbers you use, are going to pay more. 97 to 98% of small business owners, of taxpayers, are going to pay less. Now, are refunds lower? Yeah, in a lot of cases they are. It's called simple math. Remember what a refund is. A refund is your change back from the government for what you paid in taxes during the year. So think about that. It's your change. You pay them 100, they say you owe 90, they give you back 10. That's about what it comes out to a lot of times. Math is different. Every situation is different, okay? What's happening is in February, when the new law was implemented, the tables were reduced to reduced refunds, all right? But the tax bill, which is all smart business owners care about, is what you're going to have to pay in total. Whether you pay it early, pay it late, pay it as you go, really doesn't matter that much. That is going down. As a matter of fact, I've been doing this since the late 70s, mid 70s actually. Started while I was in college. 1975 was my first CPA job. This is the first tax bill that I'm going to say has something major to help small business owners, and that's the 20% deduction. All right. Every other one was really, we got some because, they passed depreciation rules or deduction rules or whatever. And usually it was like for over 1 million or over 5 million or over 10 million. Well, 99.9% of my business owners that I do work with on the local level aren't hitting that. Okay. That's just the facts. You start a business, you're doing all right, but you're not doing 10 million in sales. Today, what I want to discuss is the major tax law changes that you should be aware of that passed on December 22nd of 2017, the Tax Cut and Jobs Act, TCJA, or the Trump tax law. Figure it out yourself, whatever you want to call it. Went into effect on that date. Let's first discuss the big changes for businesses, okay? Entertainment expenses were eliminated. Let's start with the business breaks that went away. Entertainment expenses were eliminated. Before 2018, you could deduct 50% of entertaining your customers or other business associates. Under the new law, the deduction is no longer allowed. So if you take a customer to a ball game or to a play, you cannot deduct the cost of the ball game or the play. It's going to have a big effect, I think, and we'll see how it comes out. Recent IRS, well, it's not that recent, regulation, I guess, in the last 6 months, allow deductions for meals with customers and other business associates. So if you go, the cost, like let's say you take them to a local, we got the Chihuahuas, a AAA for San Diego. If I take a customer there, a client there, I can't deduct the cost of the ticket, but if I buy them food, I can deduct that, all right? If your business has a net operating loss for 2018, call me so we can try to work on making sure you don't have another loss, but let's say you do, 2018 or later, that no longer can be carried back to prior years, all right? Instead, the loss is carried forward until it is used up to offset future income. There is an exception for farmers who can go back 2 years, all right? Because farmers have a problem. Trust me. They make income like once out of every 4 years. I worked in a CPA firm that specialized in farmers. Business losses for high income owners for the years 2018 through 2025. Excess business losses are no longer deductible and instead are treated as net operating loss to be carried forward. Excess business loss mean the excess of business deductions over $250,000 or $500,000 for joint returns. And if you have that much losses, Sometimes it happens. I mean, one big thing in the news is Amazon hasn't paid taxes this year on $11 billion in profit. What they're forgetting is that they literally didn't make a profit for the first 10 to 12 years of their existence. And under the law that's passed, they're allowed to take those losses and carry them forward. All right. So they used investor money to expand. All right. So there's a lot of things. Plus, they bought a lot of equipment, which you can't reduce below zero. So as you make money, you get to use that. There's a lot of reasons in the law where you can make money this year and not pay taxes. Farmers are a perfect example of that. Farms, like I said, will make money one out of every 4 years. You can tell when it's a good year in the farm community. Everybody's buying a new car. Reimbursements for employees are now included as taxable compensation, and you now must pay employment taxes on them. So be careful about that. This is one that's more of an accounting pain in the butt than anything else. You used to be able, you traded in a car, they gave you a trade-in allowance, a business car. They gave you a trade-in allowance, and let's say, you had depreciated it fully. They gave you $10,000. You had a $10,000 profit. You bought a new vehicle at 50. You had to take that profit and defer it by reducing the cost of the new equipment from 50 to 40. All right. No longer. Now, if you sell a vehicle and you get a trade-in and you've written it 100% out, you show the gain. Now, on the flip side, if you buy another vehicle, you trade it in on another business vehicle, you don't have to reduce the cost of that. So in most cases, you're not going to see an effect. It's just more accounting nightmare. The 90% domestic production activity deduction is eliminated in 2017. Really wasn't much. That didn't apply to a lot of people. Now, let's talk about the new business tax breaks for 2018. A lot of good news here. The new law allows 100% first-year Section 179 deduction for both new and used business assets placed in service for 2018, and it phases out once you've bought more than $2.5 million of equipment. So for most of you, that means any equipment you buy, you're going to be able to write off in the first year. Large pickups and vans and SUVs with gross vehicle rate at least $6,000, used at least 50%, can now be 100% deducted in the first year. Property eligible for expensing now includes depreciable assets used predominantly to furnish lodgings. Examples are furniture and appliances used in hotels, apartments, and rental homes. Not many of us own a hotel, but a lot of us have rental homes. Commercial buildings, if you own your own commercial building, now can expense roofs, HVAC equipment, fire protection, and security system. This area is pretty darn complicated, so make sure you get with a CPA, all right? Don't miss out on the new 20% business deduction, some people, official term Section 199A. Starting in 2018, only 80% of your qualified business income will be taxed. It's a huge break. This is the one I was talking about that is there for small businesses and really was designed for small businesses because there's plenty of phase-ins and phase-outs. Large businesses can use it if they have a lot of equipment or a lot of employees, all right? If you own a profitable business, you need to contact a good tax person. This is not one that you want to do on TurboTax by yourself. Trust me. All right. C Corporation, if you're not an S Corp, that 199A is if you're a sole proprietor, a S Corp, or a partnership. All right. If you're a C Corp, in other words, the corporation is paying its own tax. That rate went from rates from 15 to 35% to a flat rate of 21%. This is going to change the way you plan. We used to try to leave $50,000 income in a C corporation because it would be taxed at 15%. And an individual rate could be as high as 39 or 39.5, 40, depending on phase-ins and phase-outs. All right. So now that first 50,000 is 21%. Now, if you have a larger corporate, you might want the rough shot of this. You might want to leave a little bit of more income in than you used to, or you might want to take it out. You really need to get with a CPA because everybody's business is different. But if you're not a C corp, this the 20% deduction is huge. All right. Businesses providing paid family or medical leave for employees qualify for a new credit that is 12.5% of the wages paid for family and medical leave. The credit is only for 18 and 19. All right. The bottom line, with all the tax changes for 2018, it's really essential that you get with your tax person. I was going to go over the individual ones, but I'll probably do that tomorrow because I don't want to go too long on this. Yeah, let's discuss that tomorrow. So anyways, rough shot of this really is very simple. If you are a business owner, you need to get with a qualified CPA, a state or an enrolled agent, somebody who really knows their stuff, who stays on top of this, all right? Because you can really mess this up. It's not as easy as it used to be. Tax simplification, forget it. It ain't happening. I don't think it's going to happen in my lifetime. It's been being talked about since the Reagan years in the 80s, and it's still not happening. Matter of fact, this new law has added some of the most complications you're ever going to see. But in most cases, like I said, 97 to 98% of the time, it's in your favor. Don't get swept away by the crazy news media showing the 1% business. The people that are paying more, we'll talk about later, really are in high tax states because of the $10,000 limit. We'll talk about that tomorrow. But until next time, this is Wayne Blau saying, let's make this our most profitable year ever, and when it is, let's keep our taxes to a minimum. Thank you very much.